Ms. Meets, can we do a mic check with you?
Yes, can you hear me?
We hear you, thank you.
Mm-hmm.
We're good, Rosie? Okay. Welcome to the June 9th, Welcome to the June 9th Audit and Finance Committee meeting. Call the meeting to order, and we'll start with approval of the minutes from our last meeting on March 10th. Any changes to the March 10th meeting minutes?
No, sir.
Cheryl, Ms. Meads?
No, sir, sorry.
Okay, that's all right. Can I have, we have limited motion and seconder options, so may I have a motion and a second, please?
I'll make a motion.
I'll second.
Thank you. Call the question. Jackie?
I call the question.
I'm sorry. We're calling the question. So do we have a, do you approve?
I approve.
Sorry.
I approve. Yes, I approve.
It's been one of those days. Do you approve the March 10th meeting minutes, Ms. Meads?
Yes.
Thank you, and as do I. So those are approved. Next, we'll move to Ms. Weinberg for the investment presentation.
Good afternoon, everyone. I wanted to start off with just giving a brief update as of April 30th. I wanted to start off speaking about the market environment. As we all know, the Fed increased by 50 basis points in May, and although the Fed indicated that it would increase rates, this would be at the expense of growth. But they're doing this to try to combat inflation. Cash balances have remained high as a lot of investors sat on the sidelines, just sort of waiting to see what the Fed would do and how they would increase rates. I will show on slide 4 how dramatically rates have been increased as compared to January when I presented last. From a district perspective, the rate increase is very positive for us. It'll equate to higher earnings. Rates are now, the 5-year Treasury, where we invest as a spread to, is currently at 3.03% versus 1.62% in January. That's a huge jump, and versus 0.98% in September 2021. That's pretty significant. We are continuing to see supply and demand imbalances, which this continues at the pressure of inflation remaining high. Consumers will continue to feel the pinch with higher gas prices, higher food prices, housing costs, and this will continue. And there is a potential of a slowdown in hiring and less disposable income to consumers. That is something that has not yet occurred, but it's just a forecast that the economists are seeing. Our investment strategy, as it's been, as you recall, we sat on the sidelines for quite a while with a lot of cash, and as rates started going up, we started investing in cash just to keep up with the yields, and we will continue to do so, just to sort of ride the yield curve as it steepens, and thus dollar cost average our investments. As of April, we have $94 million in the operating account, and this is a decrease from $184 million that we had in January. The reason for this is standard operating expenditures, land acquisitions, as well as investments. I made a few investments. The operating account is now down to 17% from 29% in January, and we like to be in the 10 to 15% range, so we are in target. U.S. agency securities are now at 25%, which is where we like to be. And our maximum for agencies is 80%. But they don't always pay as well as mortgages and other investments. And we are 40% in mortgage-backed securities. Our maximum is 50%, but I would like to get that number down. Our total yield on cash and investments is 1.2% versus 0.89% in January. So that's a nice bump for us. And interest earnings through the month of April are at $2.8 million. And just to give you a kind of reference, earnings in fiscal 21 for the whole fiscal year were $2.4 million. And we're in April and we're already at 2.8. So we are on track. I'm estimating $4 million for fiscal 22, but that is a conservative estimate. I'd rather err on the side of caution than to overshoot. This slide just shows really just how much interest rates have increased in the last few months, from January through April. As I mentioned, although the Fed did not increase rates until May, rates were already priced in April, as you can see by the yields here. And the important part of this slide is the 5-year Treasury, how it jumped from 1.62% to 2.92%. And as I mentioned earlier, we are going to be dollar cost averaging as more funds come into the operating account. Right now we're sitting on low cash, but as more funds come into the operating account, and especially in fiscal 23, November, December, we'll continue, and I know I'm going a little further out, but we will continue to rise with the yield curve. Now, it is important to note that economists are predicting a recession in 2023. And that's something very important to discuss. And the reason for this is based on the current inflation, as well as the steepening yield curve. Now, just to give some background, this is based on historical recession. Typically when inflation has exceeded 4% and unemployment has gone below 5%, that's when we see recession within 2 years, typically. Our current unemployment rate is at 3.6%, and inflation is at 8.5%. So also rising consumer prices will continue to outpace wage growth, and this eats at wealth. And you can kind of look at this as a tax. It acts like a tax on your income. Thus, it decreases consumers' disposable income, and this too can set the stage for recession. And as of now, economists are predicting about an 80% chance of recession at the end of 2023, but that's yet to be seen. So the Fed really is walking a tight line between increasing rates to fight inflation, but to do so without causing a recession. But that is tightening monetary policy. That's tough to do and steer clear of recession. Economists aren't sure if they'll be able to be successful with that, but that remains to be seen. This is a snapshot of where we are through April 30th. We had $2.8 million in investment earnings through April. 1.56% was our yield on investments only, and I separate that from cash just because cash adds that cash drag. So including cash, which the yield on that is half a percent, we go down to 1.2%. And the district was at 35% in cash and cash equivalents and 65% invested, which is where we like to be, between 65% and 70% in investments and the remainder in cash and cash equivalents. This is our current portfolio breakdown. As of April 30th, we were sitting on $560 million in cash. As mentioned before, our operating account is at 17%, and our target is between 10 to 15%. But keep in mind, this report is as of April, so we are even lower in the operating account now, so it's even less than that 17%. Mortgages, again, are maximum 50%. We're at 40%. I'm going to aim to get that number a little bit lower. Agencies, we're at 25%. Our max is 80%. That's where we like to be. So the portfolio is a lot more balanced now than it was when I last spoke. And now Drew's favorite slide, benchmark comparisons. We beat our cash index by 40 basis points. Our book yield on cash was 50 basis points compared to the index, which is 10 basis points. St. John's earned 0.81% yield versus 2.56 duration. And Southwest Water Management earned 0.69% yield versus a 1.47-year duration. And now, just to compare, we earned 1.56% yield, and our duration was 4.64%. So these are significant differences in yield because we have that extension because of the mortgage-backed securities. All still within the safe parameters as per our policy. The one thing I did want to make mention of is we are at the 1.56% versus the index, which is at 2.18%, and that's because we're still in catch-up mode. Rates have increased so quickly, and we, at this point, we're sitting on low cash, so we have to wait before we can start putting the cash to work. I did put some cash to work in February, but then obviously our number one goal is operating expenditures and AP payroll, things of that nature, so that's more important. But that's why we're a little behind the 1 to 3 year Treasury index, but hopefully that'll kind of level itself out as we move forward. But regardless of that, the good news is that we are earning more than we did in fiscal 21, and we're on target for our earnings for fiscal 22. And again, my estimate is $4 million, but that is conservative. Are there any questions?
It's, we've talked about this a couple times this year, how amazing this interest rate move has been. Mm-hmm. And I like to say it each time, it's generally not beneficial to anybody except for extremely conservative agencies like ours investing for safe income. So we're sort of in a unique position where extremely low rates hurt our income, our balance sheet for a while. And now as things move, we're benefiting.
Yes.
But on the other hand, obviously we have the same labor issue challenges and supplies, supply chain issues. So my recollection in terms of our or most of our projects, those are fixed cost projects. So I think I might have asked this last time, so apologies. As prices of materials increase, as labor increases, that doesn't really impact the project costs to us. Okay. All right, thanks. And then, Lucy, Ms. Weinberg, one of the things that we should, we may have talked about this on the briefing, but the operating account at 10 basis points.
Yes.
I think it's page.
Mr. Steinle,
Yeah.
My project managers have a different answer than me
Okay.
on that question.
So I just didn't want to leave it as like it doesn't affect us at all, because it certainly does have a significant impact. So where we'll see the differences is it's true that we don't have like an escalation clause in our contracts where if cement prices increase, then we have an increased price. However, where we realize that in existing contracts is that our prime contractors have a hard time being able to procure the services at the prices that they planned in their bid. And so how that materializes for us is they're looking for ways to submit claims because their margin is getting smaller and smaller. And so they're looking for ways to submit claims, and so we get sort of nickel and dimed to death on other things that they might not normally claim, but they're going to be looking for ways to claim money because they're losing money in those other areas. The other way that contractors will tend to deal with this kind of situation is that they will look for ways to claim time because our contract allows them to claim non-compensable time, but then that just delays our projects and it takes longer to deliver the projects. And in that time, the contractor may be able to figure out a way to not lose as much money as they go through the project. So although it isn't a specific increase, it certainly can affect us, as well as, of course, new projects we're seeing
the
bid
price goes up.
prices
Yep.
going
Yep.
sky high as we're looking at new acquisitions.
Yep, yep. And we're seeing this, what you just mentioned on the C-43 project to an extent, too.
Definitely.
Yeah, yeah. Okay.
Ms. Reynolds, in light of all those things, how do you find morale right now?
With contractors or with our
Yeah,
staff?
like, are they still, how is their morale?
I mean, I think everybody's struggling right now. I mean, you don't have to go past the person sitting next to you to like have people complain about gas prices, for example. So certainly people are complaining about things, but in general, we work with a lot of big, sophisticated, experienced companies who've been through this or similar before, and they know it's not the end of the world, but it's how do you get through the short term, knowing that, you know, things will change, right? That's the one thing you can count on. Eventually, it'll change.
Thank you.
Can we, Cheryl, Ms. Meads, do you have any questions or comments?
No, not at all. Thank you.
Can we look into, I don't know what, I assume we have flexibility, but the 10 basis points that we're getting on the operating account for our cash account, this was one that stayed higher for longer
At 1%.
relative to the interest rate environment, and now it seems to be staying lower for longer. Have we explored whether there's a better rate we can get? And if not, with the current bank, whether we should shop that account?
I will definitely look into that, but that is a correct assessment because compared to the other yields that we're getting, even the SBA is at 0.45%.
Yeah, that differential's.
That's huge.
Yeah, that's a big
That's huge
differential. So
on-
we
on
should
the
be getting
cash
it.
side.
I would think, right, that we should be getting at least what we see on the SBA, if not more.
Yeah. The only thing I would mention is we recently went through a transition from SunTrust to Truist, which they're backlogged on a lot of things. So I'm thinking that maybe that's why this kind of got put, kind of lost. But it's definitely something that I will bring up with them.
Yeah, it's a big enough dollar amount.
It is,
in
it
the
is.
sense that it's close to $100 million that, you know, I think it should be 50 basis points or higher. So that 40 basis points difference is a good amount of money.
It's definitely worth a discussion, and typically what they do, we've been a client of theirs for a very long time, and they don't want to lose us as a client. And it's kind of been put out there, especially with this transition, all the hiccups and issues that we're ironing out, thankfully, that perhaps we should consider going out for an RFP, which that has its positives and negatives, because we are such a long-term client. We do get certain kind of treatment versus if we start with a new bank. But on the flip side, maybe going that direction and actually having that discussion might kind of, you know, put fuel to their fire. And
Worth exploring. It's a
Yeah.
big enough account that I'm sure we can improve that.
absolutely,
Okay?
I agree.
Any other comments? No, thanks. Thank you.
Okay, thank you.
Any public comments, Rosie?
No, Mr. Chairman.
Okay, thanks. Let's move on to Mr. Burns and the audit report. The first one is on the report of monitoring of construction change orders.
Okay, this was a follow-up to the audit where you had requested that we give periodic monitoring of the change orders. And what we've done, the review period was from October 1st, 2021 through March 18th, 2022. And this was a review of projects that were open between 2020 through the present, or the March 18th review period. We assessed whether the change orders were negotiated during the review period, whether they were negotiated in accordance with the contract terms and conditions. We also verified the cumulative change order amounts as a percentage of the original contract amounts. Then we compared the change orders amounts to the industry averages. So during that period, there were 20 change orders that were actually executed during the review period, a total of about $2.5 million. We looked at about 1.4 million of those, or about 55% of the dollar amount. We concluded that all the the ones that we looked at, they were accurately input into the e-builder, authorized appropriately, and they were accurately calculated. The change order amounts, the gross amount was 13% for all contracts and 4% when 6 of the outline contracts were removed. And both, however, of those percentages are within the 8 to 14% of the industry average, even when the outliers are included. So with that, I'll take any questions you
Our
have.
long-term, because that was a short period of time that was assessed, our long-term, short period of time, small dollar amount, large change order percentage larger, but remind me what our longer-term change order percentage has been? Isn't it 3 or 4%?
It's, when we did the last audit, it was very similar to what we found this time. It's running about 4% when you exclude the outliers. It's usually up into the low teens when you have included those.
The outliers would include, what's the definition of an outlier?
Issues where it's an extraneous issue, maybe like a C-44 situation, for example,
Okay.
where
Any questions?
Thank you.
okay, which slide did you want me to go to? Okay.
I'm sorry, my mic's not on. Okay, I have it then. Thank you very much.
Okay.
Ms. Meads, any questions, comments?
I just would like to see the last page again, please. No, not that one. I was joking, by the way.
This is the last page. Did you want a different one?
Yeah, no. I just want to very quickly go through it one more time.
Okay.
Got it. Okay. No, I don't have any questions. Thank you. That's actually good. Thank you.
But we did, I seem to recall we did a long-term change order study, right, Jennifer, on this? We did a long-term change order study maybe last year where we determined that the district's change order percentage was significantly lower than average. So just as I see this 13%, I know it includes outliers. But it's such a short period. I just want to make sure that over a longer review period, we're still very competitive. Well, I don't know if that's the right qualifier, but we're still very low relative to typical agency change orders.
Yeah, Tim, that was one of your audits that had the longer time period, the one that we did last year, or maybe it was even the year before. And so this percentage, the 13%, that's for this, what's the review period on that?
Okay, the review period here, October 1, 21 through 22, or through March 18th, 2022. Now, bear in mind, even though we looked at the change orders that were executed during that period, but bear in mind that just because that was the period we looked at, when we're looking at the change order, we're looking at it compared to all the change orders, compared to the original contract. So it's really everything before that plus this that we're looking at. So it really, when you're looking at the percentages, you're looking at the cumulative amount, even everything prior to the October 1st, 2021. It was
How
really,
far prior? All related
all
to
the-
that project?
Back to whenever the contracts were executed from 2020 on. So,
Okay, it seems like a
yeah.
really small dollar amount if it's
Yeah.
all because some of these, obviously,
Yeah.
some of these projects are 10-year projects.
Yeah. The other thing too is, and based upon the discussion that we had, is that these are the ones that were executed during that period. This does not necessarily reflect everything that the board has authorized. There's probably a lot of money that the board has authorized that hasn't been executed yet. I mean, such as like the big one on the C-43, for
Yeah,
example.
yeah.
I believe that is outside of this period.
Yeah,
Yeah.
so
that
when you-
will be captured next round.
Okay. Yeah, I think I'm just slightly confused on the results, and maybe we can think about a different way of presenting it or time frame or something,
Yeah.
but we can talk about that.
Yeah. And one thing I think probably what we could do, maybe for the next update we give you, is start with board authorization and then show what's been executed against those authorizations. And maybe that will help to clarify things. If we
Okay.
can start with the authorization, then here's what's executed, here's what's maybe not authorized but not executed yet.
That might, if that makes
Yeah.
it a little bit clearer, I think that'll be
Yeah.
helpful.
It seems to me that it's hard to understand what the standard is, and if we're really meeting it, and if we're also, are we, and really, what does that mean? Do we see opportunities to make a process better? And if we do we through this process, are we just telling ourselves that we're functioning okay, or are we functioning better? Does that make any sense? It just doesn't. I mean, I understand what Jay's saying. It's hard with these results to really have a solid feel for it.
Yeah, I think we can review the different parameters and how we present the information. Just give us a better
Okay.
historical perspective, or understand how historical this perspective is.
Okay,
But we
yeah.
can, we can talk about that.
Yeah, I think we start with the authorizations and then, and reconcile to the executed. That
Okay.
will probably give you some better clarity on this.
Perfect.
And we'll do that next time.
Any public comment, Rosie?
No, Mr. Chairman.
Okay. So for this audit, I need a motion and a motion to approve the monitoring of the construction change orders in a second.
I move to approve.
Thank you.
Second, please.
Thank you both. And I'll call the question. Jackie?
Yes.
Cheryl?
Yes.
And I'm a yes, and that passes. And then we have, this is something we discussed doing on the last Audit and Finance, which is a annual independent financial, sort of exploring the financial audit contract, which Tim and his team looked into for us.
Okay, so what we did since the last Audit Finance Committee is we went out and we contacted 6 different firms to obtain information. One thing with audit services, they're not required to have to do a competitive RFP or anything, so we were able to, under Florida statutes, just go out and request information and quotes. 5 of these firms listed on the slide here had previously responded to our request for proposals in previous solicitations. The 6th one there, James Moore and Company, we added. I went and I looked to see who audits the other water management districts, and this company happens to be the auditor for 3 of the other 4. So we added them in for that reason. So we received responses from 3 of the 6. Carr, Riggs, and Ingram, Moore, Stevens, Lovelace, and James Moore. Cherry, Becker, Grant, Thornton, and Markham did not provide us any response. Here on the slide, we show what their proposed fees would be for each of the 5 years and the total for the total 5-year period. And on the bottom there, I show what our current contract is with RSM of $160,000 per year. Then on the bottom, I also show that when you actually do a comparison on the pricing, you can really only look at the 2-year period because we only have 2-year options with RSM that we could actually extend for. So there were 2 of the firms were slightly less than theirs, and the one firm was the same as theirs. I also include some information here regarding to give an indication of the size of the firms and the kind of resources they have. Carr, Riggs & Ingram has 72 offices. Their nearest office is in Palm Beach Gardens. Morris, Stephen Lovelace, they have 4 offices, of which their nearest one is in Fort Lauderdale. James Moore, they have 5 offices, and their nearest one is in DeLand, which is about halfway between Orlando and Daytona Beach. And then RSM's nearest office is right here in West Palm Beach. So here's 3 possible actions that the committee can consider. The one is obviously exercising the 2-year option with RSM, or you can execute a new contract with one of the 3 firms that responded. If of the 3, the best firm I'd recommend would be Carr, Riggs & Ingram. Unfortunately, 2 of the firms, Grant Thornton and Cherry Beckert, who did not send us a response, would probably be a more comparable firm to RSM, but we didn't receive any response from them. As far as the size of the firm and the kind of resources and the governmental experience that they have. And the third option, kind of a hybrid of the 2, is exercise the 2-year option with RSM now, and then 2 years from now go out for a request for a proposal for any audit firms that wish to respond to that proposal, and bring in a new firm at that time. So with that, I'll open it for discussion.
So Cheryl, I recall you had sort of suggested this exercise, which I think was a useful exercise given the fact that we've had a long-term relationship with RSM. It's been a good relationship, but I think your concern was really on the comfort factor, and so we have a couple options here, and wanted to get your thoughts.
I would choose the first option. No, I would choose the last option. I remember that we're perfectly comfortable with this with RSM and have a great history with them. It looks to me like they're competitive. It's not it's reasonable in comparison with the other firms. So I would look again in 2 years. I don't think it ever hurts to look again and make that part of the process.
I agree.
And I think I do too. I mean, I think as you said, Cheryl, that we've sort of confirmed our pricing is right and it's competitive. I think we don't want to, and I asked staff's feedback, we don't want to rush into a change. So this last option gives us some
Right.
time to prepare if we are going to have a change. So if we do change, I suggest we get in front of it. But I think also spending some time getting more information opens up the field in terms of the type of providers as well. So that might be beneficial. So I think it sounds like we're in agreement on that.
Yes.
So let's exercise that third suggestion. I don't think we have to take a vote, right?
No, you don't have to vote on this. This was just for your guidance.
Okay.
We have the options, so I just get with procurement and we'll do the contract amendment
Perfect.
with RSM.
Thanks, Tim. Appreciate
Very
it.
good.
Board of Public comment, Rosie?
We have none, Mr. Chairman.
I'm surprised the line isn't backed up. Okay, so we'll have the next meeting on December 8th. It's going to be here in West Palm, and this meeting's adjourned. Thank you.
Thank you.